In the world of investing, there are a few names that shine as bright as Peter Lynch. A legendary investor, author, and a former Fidelity Magellan fund manager, Lynch's strategies have left an undeniable mark on the world of finance. With a track record that speaks volumes and a philosophy that redefined the way we invest, Lynch's insights continue to inspire generations of investors. So in this video, I will not go over his great life accomplishments and list his many records, but rather share with you a couple of short clips in which Peter Lynch shares his insight into options trading, shorting, when to buy a company, when not to buy a company, and how to evaluate a company like Peter Lynch. What's up, strangers? Welcome to Wealth Game Nation. My name is Vedo and I'm here to help you better understand the wealth game and become part of Wealth Game Nation. The first clip that we will look at is from an interview from 1997 in which Peter talks about options trading and derivatives.
Big deal.
What about all the criticism of derivatives and the impact they have had?
That's a little complicated for me. All I know is, I don't know about derivatives.
For you?
It's way over my head. I've never bought an option in my life. Time's on your side when you own a stock. I don't know about putting 3% down and buying a future and a strap and a straddle. That's way over my head. Can't deal with that.
Is that right?
Let somebody else deal with it. Yeah.
We just heard how he never did options. He said they are too complicated for him. Of course, he's just being silly. I like his philosophy and I plan to follow in his footsteps here and never touch options. Not because I do not understand them, but they are simply way too little upside and too high of a risk. The second clip is from an interview from 2013, which is about 16 years after the first interview, and it ties very well together with the first clip. In this video, he talks about shorting, and after we look at the clip, I will tie both of those videos in and give my opinions on them.
Well, I found the long...
They're obviously tracking some...
The hedge funds that have been on the long side have done the best. They may have a little bit by being short, but being right on the long side. Because obviously, if you're right, you can make... And that's, I would say, when I ran Magellan, I might have been right 6 times out of 10. But if I'm right, I make a double or triple occasionally. It offsets the times you lose 30 or 40%. In fact, you could be right a third of the time as long as you have a lot of good results. So that's, when you're short, you can only make 90%. When you're long, you can make 10-fold or 5-fold. So I think long is the way to be.
As he speaks very fast, let's break down some numbers. He says that if you're right 3 to 6 times out of 10 times, and you make 2 to 3 times your money, you are much better off than being right when shorting, where you can potentially be right up to 100%. And this 100% is only a hypothetical 100%. In the video, he says 90%. And what he means by that is if you're shorting the whole stock market, you can never get the 100%. Because in practice, the stock market will never go to zero. It can lose 90% of its value, but that's the ceiling. If you're shorting a company, in theory that company can go to zero, it can go bankrupt, but still that is very unlikely because there's always something left of a company which can be sold off, and in practice you will never get the 100%. Plus, the stock market is unpredictable. The only thing we know for certain is that the stock market goes up over long periods of time. What the stock market is going to do in the next 6 to 12 months, nobody knows. But with a high level of certainty, we can say that in 7 years the stock market will be higher than it is today. So it's simply a risk versus reward ratio. So there's simply too little upside when doing shorting and options trading. The next clip is also from the 1997 interview where he talks about when to buy a company.
One thing you're trying to do is say, of all these public companies out there, here's the company I really like. The fundamentals are terrific. Their earnings are doing well. Their competitors are doing poorly. I think this company's doing terrific. And all of a sudden, the stock might have gone from 40 to 30 because of this decline. That would say, wow, here's a chance to buy it. So you're trying to say some companies might have been overpriced at 60 and all they did was go to 50 and say, big deal. So you're trying to find companies you liked anyway. Right now you liked them. And now they've had a haircut. That's what you would do. Not a stock that went from overpriced to fairly priced. Something that was fairly priced at the start of this exercise and then had a very, a 5-for-4 sale.
Here we see that Peter Lynch looks for fundamentally sound companies, which he then basically adds to his watch list. Even though he identifies companies that he likes, he does not buy them right away. He waits for outside factors to affect the whole stock market, so the prices drop from fairly priced to underpriced. This is the difference between him and Warren Buffett. Warren Buffett says it's better to buy a great company for a fair price than a fair company for a great price. Peter Lynch takes it to the next level. He says the company he likes is already at a fair price, and then he waits for those outside factors, so the company's stock price drops to underpriced. Examples of this happening are more common than you might think. There is bad news on every corner, and there are always things to worry about in the stock market. Most recent example, think of October 2022. Everything was down due to inflation data, recession fears, and conflicts in Europe. Extreme examples are Meta, Nvidia, and many other tech companies. Then think of March 2020, when everything due to Rona went down, and it did not necessarily have to do with the fundamentals. Then there's the 2008 housing crash, then the 2000 dot-com bubble, and so on. Those are only the stock market crashes. But there are other things such as inflation, recession, monetary policy, world conflicts, and so on. Sometimes a company has bad earnings and the whole sector from that company sells off. The last clip we will look at is also from the same 1997 interview where Peter Lynch talks about when not to buy a company.
Just think of this as being, you say to yourself, I think this company's going to earn something in the future. If it's already discounting that, if it's selling at a huge multiple, you say it has to work, and then it's only going to stay even. So you have to say to yourself, if I'm right, how much am I going to make? If I'm wrong, how much am I going to lose? That's the risk-reward ratio. In Stock Shop, we talk about, if I'm right, I hope I'm going to double, triple my money. If I'm wrong, maybe I'll lose 30, 40%. That's a favorable ratio. But you say, if I'm right, the stock's not going to go up. It's already discounting terrific things. If discounting terrific things are already in the stock, I don't want to own it.
Here, Peter talks about valuations of companies and discounting of the future prices or earnings of the companies. He says that if great things are already baked into the companies, there's little potential for outside returns. The company needs to execute near perfect just to break even with what is already in the price. There are many ways to evaluate a company. You can do the discount and cash flow analysis, Benjamin Graham analysis, his risk premium ratio, multiples valuations, dividends valuation, Peter Lynch's valuations, and so on. And in this video, I will show you how Peter Lynch evaluates companies. He uses something called the PEG ratio, which he has popularized. PEG ratio stands for price to earnings growth. It is very easily calculated, and I will show you now how to do it. In order to explain it much more easier, I threw a couple of things into an Excel, so let's look at it. First, the formula for the PEG ratio. The PEG ratio is calculated by taking the price to earnings ratio and dividing it by the expected earnings per share growth rate. It is important to note that we talk about assumptions here. We can look at the history, we can look at what was the PE ratio of the last year or the last X years, and we can also see what was the earnings per share growth rate of the past years. However, we cannot look into the future, therefore analysts and also ourselves as investors try to make assumptions. This formula, however, doesn't include dividends, and I think when a company pays dividends, this is also a return which needs to be included into the equation. So in order to get the information on these three things, we can go to any investment website that we like. I like to use the Stock Unlock website, which I'm not affiliated with. I just like the service and the guys who are building it. Here we can see that the forward PE for waste management is 24.69 and the dividend is 1.75%. If we go to insights, we can see what the analysts are projecting for next year's earnings per share. Here it says 15.6%. We can take this number or we can make up our own number based on our own assumptions. For the sake of this example, let's just take the numbers from the analysts. I already plugged in the data, and if I click on the formula, we can see how it's calculated. Basically, we're taking the earnings per share and dividing it by the sum of dividend yield and projected earnings per share growth. And we get to a ratio of 1.42. Now, what does this tell us? Well, according to Peter Lynch, everything below 1 can be considered as undervalued, and everything above 1 can be considered as overvalued. Of course, nothing in investing is black and white, but this can be a starting point. And as you can imagine, the lower the number, the more undervalued the company is, and the higher the number, the more overvalued the company is. Now let's quickly look at another example, which is United Health Group. Same exercise here. We go to Stock Unlock or any other website you like, look up the ticker United Health Group, and see that the forward PE is 18.99 and the dividend yield is 1.31. What we are missing now is the analyst expectation, and we see here in the insights that the next year projected EPS is 20.77%. If we go back to the Excel, I plugged in the data already, we can see here that the PEG ratio is less than 1, which indicates an undervalued company. However, these are only examples and I'm only taking what the analysts are projecting. So this is not a financial advice, you gotta do your own research. There you have it. Those are a few selected timeless clips from my favorite investor/comedian Peter Lynch. And I think it's easy to see why he's my favorite investor. He does not speculate, he does not try to time the market, he does not short, he does not trade, he does not use leverage, nor options, nor any kind of derivatives. He keeps it simple and focuses on the fundamentals. And when I'm a big boy one day and all grown up, I want to be just like Peter Lynch. That's it for today. I hope you found this video useful. If you have any questions or comment, please leave them down below. If you want a full review of my portfolio, go check out my portfolio review video. Link is in the description of this video. And if you're not already subscribed to my channel, please hit the subscribe button and share this video with your friends and family. I will do my best to create regular videos with updates of my portfolio. I will do more fundamental analysis and review other companies, their earnings, other investors' buys and sells, and everything around investing. Thank you so much for watching, and I'll see you in my next video.